Welcome to the Deep Dive. Today we're digging into Applied Digital, that's APLD, specifically their fiscal first quarter 2026 earnings call. This is a name lots of people are watching, a pure play on AI infrastructure. And yeah, the buzz before this call was pretty intense.
Definitely. It felt like a major checkpoint for the AI data center build-out story. And you're right, this quarter, for anyone following closely, wasn't really about the earnings per share number today. It was much more about, locking in that long-term cash flow, showing they can actually build these things and nailing down the funding.
Right, the execution proof. And judging by the market reaction, they must have hit those notes. The stock jumped, over 16% after the call?
Yeah, big move, closed near $33.99, and the volume spiked way up, almost double the average. Shows you how much tension was on this.
Okay, so let's break it down. Give us the snapshot, the headline numbers that got things moving.
Sure. So revenue came in at $64.2 million. Mm-hmm. And that really beat expectations. Consensus was hovering somewhere around maybe $51 million.
Wow. Okay. So solid beat there.
A huge beat. And it's up 84% from the same quarter last year. Now, on the earnings side, GAAP EPS was negative 11 cents.
Okay.
But the number people really watch, the adjusted non-GAAP EPS, that was negative 3 cents. So better than expected by around 11 to 13 cents, depending on whose estimate you used.
Hold on. I need to jump in there. A revenue up massively, $64 million, but adjusted EBITDA was only $500,000. That seems low. It's way down from $6.3 million last year. Usually, that kind of profit dip would scare the market, but the stock flew. What's going on there?
Yeah, that's the exact right question to ask. And it's actually strategic. It's part of the story this quarter. Yeah. See, most of that big revenue number, about $26.3 million of it, came from something they call tenant fit-out services.
Tenant fit-out, meaning?
Basically, it's APLD doing the custom work inside the data center shell for their big tenant, CoreWeave. Think specialized cabling, the pipes for liquid cooling, installing the racks.
Ah, okay. But why do that if, as you implied, the margins are low?
Because it's proof. It's validation. Management was clear. This is low margin stuff, maybe mid-single digits, but hitting that $26 million mark shows they're moving fast on the construction. It's like third-party proof that the build is real, it's on time, on budget, and that execution credibility is gold when you need to unlock the real money later, the project financing. Low margin today buys you credibility for the high margin lease revenue that starts later.
Got it. So the low margin revenue is actually a leading indicator of construction progress. That makes sense. Which brings us neatly to the main event, Polaris Forge 1, the big 400 megawatt campus. What was the big news there?
The headline news was confirmation. It's now fully leased.
Yeah.
CoreWeave took all their options. And that single move dramatically boosted APLD's total contracted lease revenue. We're talking about roughly $11 billion locked in over the next 15 years.
$11 billion. Okay, that's the durable utility-like income stream everyone's looking for. That underpins everything.
Exactly. That contract is the bedrock for all their financing talks.
So with that $11 billion secured, what's the timeline for actually building Forge 1?
They stress they're on schedule and on budget. The first building, that's 100 megawatts, is still targeted for RFS ready for service in the fourth quarter of calendar 2025.
RFS in Q4 25. So the high margin lease revenue starts hitting the books early next year.
That's the plan. Then the next 150 megawatts come online mid-2026, and the final 150 megawatts in 2027. They seem to be building faster than the old industry standard.
And they talked a lot about the tech, right? These aren't just warehouses, they're advanced AI factories. Liquid cooling keeps coming up. Why is their specific design important?
It's critical because these facilities are packed with high-density GPUs that throw off incredible amounts of heat. Traditional air cooling just can't handle it efficiently. APLD is using direct-to-chip liquid cooling. Their target power usage effectiveness, or PUE, is around 1.18.
Okay, PUE 1.18. For listeners maybe not steeped in data center jargon, what does that mean practically?
Sure. So PUE measures efficiency. A perfect PUE is 1.0, meaning all power goes to the computers. Older data centers might be 1.5 or even higher. 1.18 means for every watt powering the actual compute, only 0.18 watts are used for cooling and other overhead. It's incredibly efficient.
And that efficiency saves the tenant money over the long haul.
Huge savings over 15 years. It's a major selling point. Plus, and this is key, their design uses almost zero water. That's becoming a deal breaker in a lot of places.
Right, water scarcity is a growing issue. Okay, that clarifies the tech advantage. Let's look ahead. Polaris Forge 2. The next big project, 300 megawatts initially, up in North Dakota.
Yeah, near Harwood. They've broken ground. Construction started. They expect the first part of that to come online late 2026, fully built out in 2027. But the really interesting part, The pipeline. Management said they're in advanced talks with an investment-grade hyperscaler to lease that entire campus.
An investment-grade hyperscaler, like one of the big cloud providers.
That's the implication. And they didn't stop there. They mentioned negotiations with 2 more hyperscalers for 2 new potential sites. So the demand seems to be accelerating.
Building all this takes serious cash, though, which leads us to funding. This seemed to be another major positive from the call, especially the Macquarie relationship.
Absolutely crucial. That $11 billion CoreWeave contract really greases the wheels here. They confirmed they drew the first $112.5 million from that huge $5 billion preferred equity facility they have with Macquarie.
Right, the $5 billion facility.
Yeah, and management emphasized that $5 billion isn't the total funding. It's the equity piece designed to unlock maybe $20 to $25 billion in total capital once you add in project-level debt financing.
So the Macquarie money is like the down payment that attracts the bigger loans for each specific project.
Exactly. It helps avoid diluting common shareholders too much at the parent company level. And they're working on that project debt for Forge 1 right now.
What are they expecting for that Forge 1 financing?
They're aiming to close it this fiscal quarter. And the terms sound pretty good. Roughly 70% loan to cost, or LTC. That means debt covers 70% of the build cost. And the pricing they're targeting is a spread of about 400 to 450 basis points over SOFR.
Okay, 450 basis points over the benchmark rate. Why is that considered favorable right now?
Because it shows the lenders really trust that CoreWeave lease. They see $11 billion locked in from a strong counterparty. It makes the loan less risky for them. So they're willing to offer tighter pricing, a lower risk premium. It basically validates the whole model. Secure a big lease, then use that to get efficient financing for the build.
It all connects. Build fast, prove execution, secure the leads, get good financing terms. And management seems to be packaging this story towards like a REIT-like valuation eventually.
Very much so. They're guiding based on operational milestones and net operating income, or NOI. The first big target is around $500 million in annualized NOI once Forge 1 is fully up and running.
$500 million in NOI from just Forge 1.
Right. And then they laid out a goal, maybe aggressive but credible, of hitting a $1 billion NOI run rate within 5 years. That's the kind of language REIT investors understand.
And does that $1 billion NOI target feel achievable given the, insane demand for AI data centers right now?
I mean, the macro backdrop is just staggering.
Yeah.
You hear figures like hyperscalers planning to spend over $350 billion on AI data centers next year alone. Management threw out a comparison, like building the entire U.S. interstate highway system, adjusted for inflation, but crammed into a single year. It's almost hard to grasp the scale.
Yeah, that's a mind-bending amount of capital deployment.
And it perfectly illustrates why APLD calls themselves picks and shovels. The bottleneck isn't really GPUs anymore. It's finding places to put them. You need land, massive power connections, advanced cooling these AI factories. APLD is securing those things. They have 700 megawatts under construction now.
Right.
And a 4 gigawatt active development pipeline. These are sites they expect to start building on in the next 6 to 12 months. That pipeline, given the scarcity, has real value.
Okay. Sugoi, amazing. Let's shift to our final segment. This is not financial advice, but we always like to explore an outrageous but plausible trade idea. Analysts are already pushing price targets up. You see $40, even $56 out there against the current price around $34.
Okay, so here's the thinking, not advice, just a scenario. The market gets the $11 billion lease. Check. It gets the big Macquarie funding facility. Check. The stock has run up a lot this year, like plus 345% YTD. But here's the potential edge. Has the market fully priced in the certainty of that first 100 megawatts hitting RFS on time in Q4 25? I'm not sure it has.
Interesting. So the potential gap is in believing their execution timeline for that first phase.
Exactly. So the trade idea, go long APLD. It's a bet that management delivers on that accelerated build 12 to 14 months, faster than the old standard of maybe 24 months. The catalyst isn't the earnings next quarter. It's the announcement that the first 100 milliW is officially online, RFS achieved. That happens, the high-margin lease revenue starts flowing early next year. And that event, that proof point, could force the market to immediately reprice the stock towards the high end of that analyst range, $40 to $56. It pulls forward the valuation of that $500 million NOI run rate.
So betting on execution speed itself as the catalyst to unlock the next valuation step. I like it. Plausible, definitely outrageous, given the run-up already.
That's the idea.
All right, a great breakdown of what feels like a pivotal quarter for Applied Digital. If we boil it down, the $11 billion lease is locked, The multi-billion funding structure is in place, and there's a clear roadmap, they say, to potentially $1 billion in NOI. The story really shifted to visibility and execution this quarter.
Absolutely. And maybe one final thought for you to chew on, connecting this back to the macro picture. The Department of Energy talks about a 40 to 50 gigawatt power shortfall just for data centers in the U.S. Some experts think it could be closer to 90 gigawatts needed as AI grows. Power and land are the real constraints. So when you think about APLD having secured a 4 gigawatt active development pipeline, how much is that scarcity worth? Especially when hyperscalers are practically tripping over themselves to deploy capital.
Very potent question, something to definitely consider. Okay, that wraps up our deep dive today. Remember, everything we've discussed is for informational purposes and definitely not investment advice. Thanks for joining us.
Thanks for listening.